You've been keen on Russia for quite a while. In fact, in December last year, you said Russia would outperform other markets going into 2011. We're now almost 3 months through the year. Is that still the case? Are you still seeing Russia as a strong investment case among emerging markets and, in fact, developed markets as well?
Well, I'd call it pretty much probably one of the strongest investment cases there is out there now. I mean, we're in a low conviction world where, with what's going on in the Middle East, unfortunately, it's pushed oil up from a supply side perspective as opposed to demand. If it was demand driven, you could be bullish on growth, throughout the world. And for what it's worth, Russia missed a lot of that initial recovery in emerging markets because its cyclical recovery lagged. We were actually overweight Russia all of last year, but we were pitching it mostly on a risk-reward basis, not because it had momentum. It's a boom-bust economy in most people's mind, and the bust had already happened, so we were saying the upside is yet to come. So our key story, as it was through December, was the cyclical recovery, which has only really started to accelerate since August, and as this country works, it should work in a pretty aggressive way. You throw in the mix what's going on with oil, this is a windfall for Russia. There are a few countries out there where you can say what's going on, growth concerns, oil supply side shock. Most of the countries it directly benefits technically are the ones that are exposed to this political risk that we're seeing in the Middle East. I think people are relatively comfortable with Russian politics, partially because they're so comfortable with who the players are. And ultimately, this is a major windfall. So amongst emerging European investors, they've already switched into Russia. They've gone out of Turkey, they've gone into Russia. The ones that are closest to Russia are there. They were there because the cyclical recovery was happening. Global emerging investors haven't moved into Russia as aggressively as they otherwise would have, considering how much they like oil, for instance, in Russia, which is new. And they're broadly neutral, but global money hasn't really moved into Russia yet because it's happened at the same time that emerging has come out of favor relative to developed. And global emerging funds are also seeing some fund outflows. So relatively speaking, we don't think the opportunity in Russia, the surface of it has yet to be scratched. This is a big windfall for Russia. It was going to do fine regardless.
So we have seen some of those portfolio flows going out of emerging markets, as you mentioned this year, leaving markets like South Africa. Is any of that being directed into Russia at this stage, or is it really going back into developed markets?
Well, there's some that's within a GEM fund. If they're seeing outflows, they basically have to maintain what they want to keep, and then they sell whatever else they need to sell to fund those outflows. There is money that has been going obviously into dedicated Russia funds, but to the extent that they can move the needle, this is a longer term trend. how do emerging market investors generally invest, as opposed to are we just attracting shorter term retail money or whatever it is into Russia specifically. So on balance, we've seen funds have come around to the Russia story. Most buy into it. Plenty are overweight, but there's still a lot of global emerging funds actually that technically can't buy onshore Russia, so they're only stuck with GDRs and ADRs and these sorts of things, and that limits the pool quite a bit. So I would say on balance that Russia is underowned from that perspective. From a developed emerging perspective, the move into developed is now a little more at risk because we were in an environment where people thought that inflation was back, which implicitly means they thought the US was back because it was growth-driven inflation as much as anything. And the supply-side oil shock has given people a lot less conviction. So I would argue probably this is an equity-unfriendly environment generally, and you have to pick your places.
How about South Africa? Would you pick South Africa as one of those destinations for funds at this stage?
Well, from one perspective, I mean, what people are talking about right now is you've got the renewal of the terms double dip and stagflation, which had disappeared for a while. And that meant that for a lot of last year and during the crisis, funds were buying pre-existing growth that they could bank on, because growth for tomorrow, where countries were perceived as double dip candidates, they weren't really willing to go that extra mile. Now what you saw basically since November, you saw a lot more willingness to buy into future growth, hence the recovery in some of the developed markets like the US. And now ultimately with that being more challenged, there is an element where people need, again, bankable growth. And this is where South Africa looks pretty good. I mean, South Africa, I think, is very, very unlikely to be a double dip candidate. It's more just a question of is it fascinating within emerging context. But so when everything is growing, South Africa has a little more trouble competing, partially because of the advanced stage of Dutch disease, the current commodity-driven strength of the currency and all the negative ramifications that has. But ultimately, I would say people should be reasonably comfortable owning South Africa, but I don't think it's going to get anything close to a windfall, because one thing we're seeing is oil separating itself from resources. If this is a growth, if it's the supply side oil shock constrains growth expectations, as it is effectively globally with the exception of a few markets, it's probably not great for resources generally. So up until now, we've seen resources and oil moving hand in hand as inflation hedges, as beneficiaries of QE1 and QE2. But now there's probably more of a case for that to be differentiated. So from that perspective, resources are probably a little more vulnerable in South Africa. And the second perspective is the currency is very strong, obviously. One thing that keeps it strong is resources. But if resources do roll over globally because global growth becomes more constrained, you would have thought that the South African rand would be a little bit vulnerable. I mean, we have a very big conference next week. There's tons of interest in it, so it's not as if they're, South Africa's off the map at all, but a lot of investors would be a little more comfortable buying domestic-oriented, interest rate-sensitive names at a slightly weaker currency level, I would have thought, when it's clear that there are some downside risks to the currency. On balance, the rand's probably going to be a strong currency over time. But you go through these cyclical periods where the risks are on the downside.
Well, lots of those domestic facing stocks have been pushed higher, mostly due to foreign buyers who perhaps put a different valuation on retailers in South Africa. I mean, within an industrial space, would you be looking at retailers? Do you think they have run too hard? They have been pushed too high? What would you find attractive in the industrial space?
Yeah, I don't want to talk too much about specific stocks if I could avoid that, but ultimately the argument in terms of retail, there is an element here where global investors, just generally, global emerging investors think on a multi-year view. And they think, what is it that is going to grow? What is it that's giving me exposure to this emerging market opportunity? So they wouldn't care if something's going to underperform South African resources, for instance, if they think that this is a business that's worth owning. And I think that's what captured people's attention with retail last year. Another thing that captured people's attention with retail is ultimately the consumer was there last year. If you go back to the end of 2009, the South African consumer was perceived as dead. There was no activity. Everyone came. Was extremely bearish but ultimately there was no activity of the consumer anywhere in the world. And a lot of people said the South African consumer is too heavily indebted. They're not going to work. They worked. The South African consumers who were employed because of real wage growth and indebted because of the South Africans' borrow variable ended up having just about the biggest gains in free cash flows of any consumers globally if you were an indebted employed South African. And that's one thing the market probably missed, and that's one thing that's delivered. So you have to separate. It's not purely that people are buying retailers that they specifically love. Part of it was just buying the cycle, as you saw, because people have walked away from a lot of these retailers recently.
You mentioned the rand. Which other risks do you see to the investment case for South Africa apart from the rand? Well,
I mean, one thing that South Africa obviously has to deal with longer term is the issue of, I'd mentioned Dutch disease, effectively, the strength of the currency weighing on the export sector broadly, commodities specifically. Ultimately, if you take a step back on South Africa, a lot of the world has progressed from a privatization, from a liberalization of administrative prices, from effectively state control of the economy, has moved well beyond South Africa in the course of the last 15 years. So in a very crude snapshot perspective, some of these issues associated with the unions, we should not be in an environment where double-digit wage negotiations are even perceived as possible when inflation's at 3.7% and the world is still so questionable. But ultimately, that's what happens here. So until that cycle is broken, what it means is excessive underlying inflationary pressure from a wage perspective. It means, on balance, unfortunately, the SARB has to be the one institution fighting inflation in this country, and that is, exacerbates the Dutch disease, because over time it means higher interest rates than you would otherwise have. So that cycle needs to be broken. We've been relatively secular cautious South Africa and secular cautious Russia, to be fair, but we think both countries have a huge amount of reforms that they need to address over time in order to be firing on all cylinders. But in between, you can obviously pay attention to the cycle. But I think there would be a night and day shift in terms of how people view South Africa if that cycle was broken.